Good. Good morning, everyone. Again, I'm delighted to be with you. I really mean that. I've been involved in the world of small business financial management for over 50 years now. And if you just quickly mentally calculated that makes me approximately as old as dirt, that would be correct. You know, as the insurance commercial says, you know, I know a thing or two because I've seen a thing or two. I was with Armstrong World Industries in the treasurer's office for 35 years, and a lot of that time included a stint working with Armstrong customers, building material wholesale distributors and contractors and retailers, to help them with their own business financial management process and their small business. And after I retired, I joined SCORE, and I've been a SCORE volunteer for over 20 years, you know, with a focus on business financial management. So I'm going to say a strange thing next. It won't be the last time I say a strange thing, but I'm going to tell you why you're here today. You know, you may think you know why you're here today, but you know, why are you bothering to take the time and make the effort to be here today? Well, the reason you should be here today is simply this: the very most successful, best business owners and managers are those who understand and hawk their financial statements and their financial reports constantly, every single month. They mine that information for hints and suggestions on strengths and weaknesses and opportunities for improvement. And they are reviewing their financial reports every single month with themselves, with their team, with their accountant, with their SCORE mentor, and you want to be like them. That's why you should be here. So with that background, let's look at the next slide, Kathy, and we'll get this thing going. These are my basic workshop objectives. We need to start with a review of the basics, you know, of financial statements and cash flow forecasts, because we need to all be on the same wavelength with regard to terminology, you know, and the information I'm going to be reviewing and discussing. So I just want to make sure that everybody is on the same wavelength with me. I'm going to introduce a simple cash flow projections template and do a review of an example of that template for an existing business, and show you how that tool is vital for today's business management purposes, especially, you know, in 2021, when we've just finished going through the tremendous upheaval of 2020, and we still have a way to go before we're getting back to some kind of post-COVID-19 normal. So financial management, financial planning and financial management has never been more important for a small business. Let's look at the next slide, Kathy. Let's just plunge straight into the financial statements overview. I mean, some of this might be a little bit simplistic. Don't want to feel like I'm talking down to you. I just want to make sure we're all on the same wavelength. If you think about business financial operations, you've got transactions that occur all throughout the day, the week, the month, the year, and their orders and their production and their shipping and invoicing and accounts receivable collection and expense payment, and all of that activity is recorded basically in 3 financial statements. Most people think it's 2. Most people only pay attention to one of those financial statements, but I'm going to tell you it's three, and you really should be paying close management attention to all of them. The first one, obviously, is the income statement, income and expense statement that records all the income and the expenses during the period of time, whether that's a month or a quarter or a year. And of course, that one's commonly called the P&L statement, the profit and loss statement. I don't know why some idiot named it profit and loss. It's either profit or loss. I don't know how it can be both, but somebody called it profit and loss and it stuck. So the income statement is the one that all of you are familiar with, and most people that pay any attention to their financial reports pay attention to that report. And we'll talk about that in a little bit. The second one is the balance sheet. And it's just as important for business financial management purposes as the income statement, but most people don't pay that much attention to it. If the income statement is the motion picture of the business, which is what the icon or the GIF says, and it shows the movement of the business through time and whether the business is growing or that is accelerating or decelerating, and whether it's profit or profitable or losing money, that's the motion picture. But the balance sheet's the snapshot of let's say the moving train. It captures what the financial position of the business looks like at a given point in time. So December 31, 2020, the financial position of the business looks like this. 2 months later, February 28, 2021, it looks differently, because the balance sheet shows the assets and the liabilities of the business captured at a specific point in time. And I'm going to talk to you about how the two relate to each other. The third one is the cash flow statement, and it shows the cash effects of the transactions that are occurring in the business, both those that are reported in the P&L statement as well as those that are reported in the balance sheet. And the cash flow statement is really kind of like some people call it a where gone. Where did my cash come from? And where did my cash go? So it's a different picture of the financial results of the business that's portrayed in the cash flow statement. So let's look at each one of them individually. Next slide, Kathy. Here's a typical P&L format, that I prepared for your purposes. This could be 1 month or it could be 1 quarter. Hopefully it's not 1 year, because if you got a business that's only got $50,000 of revenue for 1 year, you got a problem paying yourself an adequate income. So let's say this is 1 month, and the P&L statement is showing the revenue from the proceeds of sale of products and services. It's showing the cost of goods sold, which is the direct cost of producing the products and or services, the material that goes into producing the product, the labor and the fringe benefits, the payroll taxes associated with the labor cost to produce the product. And in this little example, the cost of the sales that were sold was $30,000. The difference between net revenue and cost of goods sold is gross profit margin. And in this particular case, it's 40% of sales. One of my associates one time said to me, quote, "Gross profit margin is more important than your mother," unquote. And it stuck with me, all my life. And he's about right, because if you've got a business where the gross profit margin is fairly normal for your type of business, then you really have a chance to succeed by controlling your expenses and driving the sales results to the bottom line profit results. But if you've got a business where the gross profit margin is much worse than the industry norm because your costs are too high or your productivity is too low or your sales prices are not adequate, you have a real hard time making making a profit. And if the gross profit margin is too high, you're holding an umbrella over the competition's head, because they can come in and steal business away from you with lower pricing. So gross profit margin is a critical key to success in any business. And then you've got the operating expenses, and I'm just showing a few examples. You know, the salaries of maybe the owner, you know, rent, advertising, supplies, other types of things. Those are the kinds of expenses that are either fixed or semi-fixed. They don't vary according to sales. They're there. I mean, the rent's there whether you got sales or not. You know, and the supplies and the owner's salary is there whether you got sales or not. So they're fixed or semi-fixed. And so in this example, it's $13,500 of expenses, leaving a $6,500 profit from operations. A lot of people call that Ebitda, E-B-I-T-D-A, which stands for earnings before interest expense, taxes expense, depreciation, and amortization expenses. It's also sometimes called cash flow, that level of profit from operations, because that's profit the business is producing that's necessary to cover the interest expense and repayment of principal on loans. So it's cash flow that's created to cover debt service, principal and interest payments on borrowed money. And then, of course, the net profit before tax for the business. And I'm not showing anything regarding tax here, because that could be all over the map depending on the legal nature of the business entity. Classic P&L statement, it makes total sense to express that information in percentage terms, because it allows you to easily compare income items and expense items as a percent of sales, and it allows you to compare 1 month versus 1 quarter versus another quarter, and 1 year versus another year. Let's look at that in the next slide, Kathy. This, if you don't know it already, this is a P&L statement by month and for the year to date versus plan or budget that any software accounting system automatically produces. In Quickbooks, there's a menu that's with one click of the mouse says, give me, you know, the income and expense statement by month, you know, for 2021, including the year to date and the plan information. So you can see how the business is doing in terms of sales, gross profit margin, and operating expenses and profit or loss. If you don't have a plan or a budget, that's one great way to use SCORE services, because the SCORE mentors are very happy to work with you on a one-on-one basis to help you create a budget for your business that can help you guide yourself during the course of the year. Budget is basically, here's what I hope and expect to achieve in terms of the operating results of my business. And if you're constantly comparing how you're doing versus budget, it helps you to identify opportunities for improvement. So I think this is one statement format in QuickBooks or whatever else you may be using that's absolutely essential for an owner to review every single month with himself and his team and his financial advisors. Next slide, Kathy. Balance sheet. So, simple example. I think of the balance sheet as saying all of the assets of the business are the things that the business owns. The business owns the cash in the bank account. The business owns the accounts receivable due from customers, where the customers have been invoiced but haven't yet paid. The business owns the inventory. You know, the business owns the PP&E, which stands for property, plant, and equipment, or fixed assets. If the business owns land and buildings, that's part of fixed assets. Otherwise, it's furniture, fixtures, tools, equipment. And in this particular example, the total assets of the business at this particular given point in time is $100,000. And the right-hand side of the balance sheet says this is what the business owes. It owes money to its trade creditors, and it owes money to its shareholders, or the owners of the business. So it owes money to trade creditors and accounts payable. It owes bank debt, which are the total liabilities, and also, it owes the balance to shareholders of the business. Another way to look at it is to say that the creditors of the business have a $28,000 claim on the assets. That's the liability creditors have a $28,000 claim on the assets, and the owners have a $72,000 claim on the assets. Down at the bottom, I'm showing you the so-called, quote, the financial formula, unquote, which is assets equals liabilities plus owner's equity, or net worth, commonly called net worth. 100,000 equals 28 plus 72. Or the other way around is that assets minus liabilities equals owner's equity, or net worth. Classic balance sheet format and comparative analysis of the changes in the balance sheet month to month, quarter to quarter, year to year is what gives an owner some insight into the business from a financial management point of view. Let's go to the next one, Kathy. This is the third financial statement that I said most people don't pay attention to because it's not automatically produced by the accounting reports. It's QuickBooks. It's got to be derived, and most people don't pay much attention to it, but it can be very, very helpful and insightful in terms of the business. This is the historical cash flow statement I'm going to coming into now. I'm going to show you another which is futuristic. But this cash flow statement is basically saying what are all of the transactions in the business that impacted cash in my business. What are all the items in the cash flows in my business that relate directly back to income statement transactions or balance sheet changes? And there are really three types of cash flows. One is cash flow from operations, which is sales minus costs equaling profit or loss. Another is cash flow from investment activities. I'm using cash to invest in additional equipment. I'm a contractor. I'm going to buy a new F-150 pickup truck because I love pickup trucks. Or I'm investing money in additional inventory to support my business. Or I've got increased accounts receivable, from increased sales. And so those are cash flow events from investing in assets of the business. And the third one is cash flow events that are of a financing nature. I'm borrowing money from my friendly bank and paying it back. I'm making dividend distributions or profit distributions to myself as the owner, which doesn't appear in the P&L statement. It's a balance sheet transaction, the profit distributions. And so those are the three types of cash flows that show up in a historical cash flow statement. And in the case of the P&L, the bottom line is profit or loss. In the case of the cash flow, it's the net change in cash in the bank, from month to month, or quarter to quarter, or year to year. And there really are, as the last bullet point suggests, situations where a business can be profitable, but it can go out of business because it doesn't have enough cash. it spent too much money on fixed assets and wasn't able to support it, or it's not collecting its accounts receivable fast enough, or it's got too much money tied up in inventory and it can run out of cash and can't meet payroll, and then you're done. So cash flow and measuring it and managing it is just as important as understanding the P&L and the balance sheet. Let's look at the next slide, Kathy. I won't go further into this particular PowerPoint slide because I've already covered it verbally, and you can look back at it for further information when you review this after the workshop today. So let's go to the next one, Kathy. This is a good one to help you understand what I'm trying to say here. And obviously the question is what are the transactions that show up in the cash flow report that don't appear in the P&L report? Well, you're looking at 6 major items. One is repayment of the loan principal on interest-bearing debt. If you borrow $120,000 from your friendly bank and you're paying it back over 6 years, $20,000 of principal per year plus interest expense. The interest expense appears in the P&L because it's a tax-deductible expense, but the principal repayment doesn't appear in the P&L. You're just paying money back to somebody that loaned it to you. I handed you a check for $20,000, and 2 days later you handed me a check back for $20,000 to repay me. That doesn't appear as a P&L event, but it's a cash flow event in the business. Profit distribution to owners. W-2 salary compensation is in the P&L, but distribution of profits, or dividends, same thing, is a balance sheet transaction, doesn't appear in the P&L. Same thing with increases in inventory, accounts receivable, and accounts payable. Purchases for cash of new fixed asset. If I spent $37,000 on that used F-150 pickup truck, it's a cash flow event, because it's cash out of my pocket, to the seller of the pickup truck, but it doesn't appear in the P&L. I borrow money from my friendly bank to help finance that pickup truck purchase, and so I increase my long-term debt. Again, it's a cash flow event, but not a P&L event. And finally, the increases and decreases in bank line of credit. The money that flows in and out from a bank line of credit day to day or month to month in the business. They're all things that are definitely impact the financial operations of the business, but don't show up in the P&L statement. Let's look at the next slide, Kath. Here is my meager effort to try to show you the process of constructing a cash flow statement. On the left-hand side is the income statement example we've just looked at. In the middle is the balance sheet format we've just looked at, but it's a beginning and ending. Let's say its start is January 1, 2020, and end is December 31, 2020. So it's a year, or it's a quarter, or it's a month. It doesn't matter. And it's showing the change between the beginning and the ending assets, and the change in that third column in the balance sheet between the beginning and the ending of the balance sheet, and the liabilities and the shareholders' equity. And on the very right-hand side of this slide is the cash flow statement that I have created, and all of the information comes directly out of the income statement of the balance sheet. 100% of it comes out of those two financial statements. And this is an example of the where gone. I started the year or the month with $18,000 of cash. Let's just say this is a month. And in terms of cash flow from operations, I had a $5,000 net profit, which is an increase in cash, a source of funds. I could add back depreciation expense because depreciation expense of $1,000 is a non-cash expense. Just to make sure we're all on the same wavelength. If I bought that F-150 pickup truck for, let's say, $35,000, and I estimate that it has an estimated useful life of 7 years, then I am, quote, depreciating, unquote, that truck $5,000 a year over 7 years, and so I'm expensing, that pickup truck over its estimated useful life. That's my depreciation expense, and it appears in the P&L, and it's tax deductible, but it's not a cash event. The cash was paid out when I bought the truck. The depreciation is an expense that's just a non-cash expense, so it's really an add back for cash flow from operations. I increased accounts receivable by $2,000, because the sales were going up, or I didn't collect my money as fast as I arguably should be. So it impacts cash. It means it's less cash that I have that I would have had because of an increase in accounts receivable. I increased my inventory by $1,000. Well, how do you increase your inventory by $1,000? You reduce cash. You write a check. And so it's a cash flow event. I increased my accounts payable by $2,000. So that's a positive cash event because it's kind of like borrowing money at no cost from my trade creditors. And I had some increase in accrued payroll. And so the net cash from operations is $6,000. It's $5,000 profit plus $1,000 of depreciation expense added back, minus the increase in accounts receivable and inventory, plus the source of funds I got from increased payables and increased accrued payroll, and the total of all of that, $6,000. What happened with investment activities? Well, I purchased equipment for $3,000. It's a negative cash flow item. What happened with financing activities? Well, I decreased my loan, my bank debt, from $21,000 to $20,000. So I paid back $1,000 of bank debt. And that's a negative cash flow. The total net cash flow in that period is $2,000. It's $6,000 from operations, positive. It's $3,000 negative from buying equipment, and it's $1,000 negative cash flow from paying back bank debt. 6 minus 3 minus 1 equals 2. The cash that I had in the business went from $18,000 to $20,000 as a result of all of those events. So the cash flow in the business was a positive $2,000. That's a completely different picture than the income statement, which was a positive $5,000. Let's look at a slightly different picture of the same situation. And all I've done here is show the same income statement, the same balance sheet, except the ending is different. I increased inventory by $3,000, not $2,000. I only increased accounts payable by 1, not any payroll, and I still paid back $1,000 of bank debt. So now, and I changed the cash starting and ending period to show you the difference. I started with $22,000 of cash. I added back my income. I added back depreciation expense. The increase in receivables is $2,000, but the increase in inventory is $3,000. Net result of all of that is that the cash from operations is $2,000 positive, not $6,000. Purchased the same equipment, purchased paid off the same loan, $3,000 or $1,000. My net cash flow is a negative $2,000. So cash went down from $22,000 at the top of that right-hand column to $20,000 at the bottom. I had a $5,000 positive profit and a negative $2,000 cash flow. And it's all because of financial transactions in the business that impacted my my cash flow negatively, as opposed to positively. If I'm an owner of this business or the owner's financial advisor, like a score mentor or maybe an accountant or a CPA, and I'm looking for strengths and weaknesses and opportunities for improvement, I probably would be saying, hey, Joe, that's a pretty damn fine profit for the business. It's 10% of sales. I'll take that all day long. But you've had negative cash flow, and if you continue at a negative cash flow, you're going to run out of cash. What can we do about that? And of course, it begs me to look at how I can collect my accounts receivable better. What does my accounts receivable aging report look like? If you don't know what I'm talking about, that's also a standard report in Quickbooks, for example, where you say Quickbooks as of February 28, 2021, show me my accounts receivable aging report. And it produces a report of everybody that owes you money in accounts receivable by name. And it shows the information that the invoice is 0 to 30 days old, or 31 to 60 days old, or 61 to 90 days old, or over 90 days old. And you can see by customer who's paying you when, and where you need to target your efforts to go after collection of accounts receivable to make sure you get paid for the products or services that you've provided. And I would probably say, Joe, let's look at inventory management. Are there opportunities for improvement in inventory management and buying practices that can get cash out of inventory to do business with a $27,000 level of inventory or $25,000 level of inventory, not 30. So inventory management, inventory turnover, would beg to be reviewed in this particular example of looking at strengths and weaknesses and opportunities for improvement. My point being that if you're not looking at financial statements like this on a monthly or quarterly basis, then you're not seeing a complete picture of your business from a financial point of view. You need to look at that third financial report, the cash flow report, not just the income statement or the income statement of the balance sheet, in order to assess strengths and weaknesses and opportunities for improvement. And that's what really excellent financial business owners and managers are doing every single month in their business. They're sitting down on March 15th to review the February financial reports and the year-to-date January plus February financial reports, and comparing them to the same period of time last year, and comparing them to plan, and answering the questions: what are my strengths, what are my weaknesses, what are my opportunities for improvement? And they get better as a result of that financial management discipline. That's the value, of looking at cash flow statements in addition to income statement and balance sheets. Next slide, Kathy. Now I'm going to pause to grab myself a drink from my cup of coffee. We put this one in here because cash flow management is clearly one of the most important tasks of the owner for a small business. You can't run the risk of running out of money and not being able to meet your payroll. And especially in last year and this year, this became even more important than ever, and still is. I mean, we're not out of the woods yet. We may have another 6 months to go in our world before, hopefully, God willing, we're back to some kind of post-COVID normal. But lots of businesses have had to pivot. Lots of businesses have had to reorganize and restructure their business and figure out how to manage their cash flow requirements in ways that they've never had to do before in 2020 and 2021. So for them, cash flow management has kind of been like a startup business, where you got full operating expenses, but when you're starting back up, you've got negative cash flow for the first 6 to 12 months. Imagine if you are a bar restaurant business and you had to shut down for 3 months because of COVID, and then you're having to start back up, and you're starting back up at 25% of capacity and maybe later 50% of capacity. It's a totally different ballgame. And so cash flow can be, for a business like that, almost like a brand new startup type business. And in a case like that, managing and doing cash flow projections, which I'm going to show you in a few minutes, becomes more important than ever. Next slide, please, Kathy. I know I'm throwing a lot of stuff at you guys, and if you feel like you're drinking out of a fire hose, don't you're not alone, okay? It takes a while to absorb some of this stuff, but hopefully we can field any questions that you have during the Q&A period. Let's switch to the future mode, not the historical mode, because I want to switch now to the cash flow forecast, as opposed to examining what happened in the past. Where gone, where did my money come from, and where did it go cash-wise? I want to switch to forecasting future cash flow, which is an important business management process to make sure that you don't run out of money from events that you can reasonably project with a cash flow forecast. If you project a shortfall of cash in any particular period of time, you must proactively address the issue, with increased sales and collecting accounts receivable faster, or even working with suppliers, as people have done in the past year, to arrange delays in payment, working with a landlord to agree on delay in rent payments for a period of time, or getting additional bank financing. So managing future cash flow is really a function of projecting it and recognizing reality and then doing something about it. Let's talk about the tool for that. Kathy, let's go to the next slide. We're going to provide you with a blank cash flow template form, but I'm not going to show it now. I want to show you the filled-in example, of that template, and walk you through the numbers to explain, how I would do it and or use it, as a small business owner. So let's look at that example, Kathy.
Lou, maybe before we bring it up, does anybody have any top of mind questions that you want to ask before we go into it?
Yeah. If you do, unmute yourself and shout out, or throw them into the chat room.
Okay.
You got all this down, Jeff? You good?
Yes. Lou, just one comment. I think that my observation is that in a number of cases where I've had these discussions with clients, we really fixate on the first two statements. We don't fixate on the cash flow. And I think what's so vitally important is that one slide that you shared, it's entitled "A Slightly Different Cash Flow Situation."
Mm-hmm.
And when I'm able to walk through that slide with a current business owner, they're actually able to see with real numbers the fact that they can think they're doing fine on their income statement and on their balance sheet when in fact they're actually bleeding internally and they don't realize it.
Yes,
And while it may not have an immediate effect on their business, it will in fact manifest itself 3 months, 6 months, 12 months down the road. And all of a sudden there becomes this aha moment around, why am I in trouble? And, you know, that one slide is just a wonderful visual that depicts why it's important to watch your cash flow.
Thank you, Jeff. I couldn't agree with you more, you know, and I appreciate that observation. I've certainly had that same experience with more than a few clients over the years. You know, the aha moment, the light bulb moment, the come to Jesus moment. You know, it's all like, whoa! I see the light. You know, because it's a different picture, and it's a picture I need to understand. So thank you.
Lou, a question has come up. How the cash flow can influence the price of a business when you want to buy it. For example, if you have a partner that wants to sell you his or her part of the business, how cash flow can increase or decrease the price that you will pay for the part of the business?
Well, that's a fabulous question, and if the questioner has a couple of hours, we can tackle that question, you know, in a big way. The oversimplified answer to that question is that the value of a business is totally a function of its earning power, its P&L results. It's really the answer to the question, how much should you be willing to pay for a business that produces a profit that looks like X? You know, and the answer to that is typically a multiple of earnings. 3 times earnings, 4 times earnings, 5 times earnings, and earnings defined in a certain way. But the actual cash that the seller would receive, or the cash that a buyer might have to pay, is definitely going to be influenced, you know, by how that business normally collects its accounts receivable, you know, whether it collects its receivables in 30 or 60 or 90 days, whether that business is a good business from an inventory management process. I mean, if you're a Walmart, do you know how many times you turn your inventory a year? Or do you know how many weeks of inventory you have on hand at any point in time? I'm going to tell you, you got about 2 to 3 weeks of sales, you know, in inventory if you're Walmart. That means if you've got 2 weeks of inventory, you're turning your inventory 24 times a year. That's a very different business model than one where you're manufacturing wheelbarrows and you've got 4 months worth of inventory, you know, in your business. And it's a very different cash flow, you know, type business. So the oversimplified answer to that question is that the ideal business, the perfect business, has no assets. It has no inventory, it has no accounts receivable, and it doesn't need any F-150 pickup trucks. All it does, of course, that's a know-how business. You know, that's a know-how business, a consultant business. The problem with a consultant business is getting people to pay you for what you know. You know, that's hard to do. But the ideal business has no assets because it doesn't have any money tied up. It's not tying up any cash. But a business that has a lot of assets in machinery, equipment, land, buildings, tools and equipment, and inventory and accounts receivable, that's a very different type of business animal from a business value and a price point of view. That's actually the short oversimplified answer to the question. You know, the long one is 2 hours.
Well, it's a good question, and one that you can either discuss with your accountant or your SCORE mentor should you want to work on this valuation to be able to assess what you're going to do.
Yeah, it is, by the way, for anybody that cares or anybody that's in this webinar that knows other people. Business valuation and buy-sell deal structuring is something that we as SCORE mentors work with SCORE clients fairly frequently, a lot more than we used to, and so it's something that we're quite familiar with and happy to help you or others that you might know if you need a SCORE mentor for assistance in that world. Any other things at the moment? Is anything else in the chat room?
No, not question-wise. I think we can, I'm going to go ahead and bring up the example and you can share it.
Okay, fair enough.
Okay. Can you see it, Lou?
Yeah, I can.
Okay.
I'm going to move my ugly mug off the screen so I can see all of it. Okay. This is a SCORE template, and it's a future, cash flow template. I call this one ABC Sealing Systems Contractors. It's XYZ company, and it's basically saying, first column, it's March 1, 2021. I have $45,000 of cash in the bank. What do I project that my future cash flows are going to look like over the course of the next 12 months? And this particular type of cash flow forecast is normally updated every single month because there are going to be changes between expectation and actual, on a month-to-month basis. In this particular example, what you're looking at is something like a checkbook register. Cash at the beginning of the month is X, all cash receipts are Y, all cash disbursements are Z, and cash at the end of the month looks like such and such. So it's just like a bank account checkbook register or a bank account statement of cash flows. In this little example, I'm saying I'm expecting to collect in the month of March $20,000 from my accounts receivable. So the total cash I have available is $65,000, 45 plus 20. I'm going to pay out $26,800 to pay my suppliers for cost of goods sold. I've got $14,514 of wages that I'm going to pay this month, including payroll taxes. For simplicity, I just showed operating expenses all grouped in a $4,375 number. Rather than splitting it all out, the template provides a basis to split it all out. Supplies, repairs, and rent, advertising, accounting, telephone, utilities, insurance, etc. And at the bottom of March, it says I've got a subtotal of cash out of $45,689, and I've got principal and interest payments to make on my existing bank debt of $833. So the cash I paid out is $46,500, which is in excess of what I collected. So my cash position at the end of the month is slightly lower than it was at the beginning of the month. It's $18,478. And I put that in the beginning of April, back at the top, Kathy. And I do the same forecast for April. Collect 40,000, pay out cost of goods sold. Scroll down for me, Kathy. Kathy, can you scroll down? Oh, too far. I just want to show the cash paid out. Just go down below. Yes, go down below line 16. So again, it's the same type of stuff paid out. And what's the ending balance at the end of April? My cash is now down to $11,956 because I paid out, what I paid out was substantially more than what I brought in. So while we're in this position, let's look at May. In May, I'm expecting, in addition to operations cash flows, collection of receivables and payment of payables, I'm expecting to spend money, $10,000, on purchasing some piece of equipment, for my ceiling systems contracting business. So that's a cash flow event. And because of that extraordinary event, scroll back up to the top, Kathy, of May. I had to borrow $10,000, line 9, bank line of credit increase. I had to borrow $10,000 from my friendly bank to cover my negative cash flow, primarily to cover the unusual $10,000 that I'm spending on a fixed asset. Let's scroll back down and see what happened in June, Kathy. Major event. I paid a $20,000 cash distribution or profit distribution or dividend to myself, the owner. I wanted to buy a bass boat with a new motor, and a trailer to go fishing. I don't know whether a bass boat and a motor costs $20,000 or not, but I took $20,000 out of my business as a profit distribution to myself. So my cash paid out that month, normal cash paid out plus an extra $20,000 was almost $70,000, which meant that in order to have any cash at the end of the month at all, which I have to have another bank line of credit borrowing. So in this little example, Kathy is going back to the bank line of credit. I borrowed $27,000 additional bank financing in the month of June, or I'm forecasting that I'm going to have to. I'm forecasting that in July, I'm going to have to borrow another $7,000, in August, another $1,000, another $5,000 in September. A total of all of that is 10 plus 27 is 37 plus 7 is 44, 45, $50,000. I got to have bank financing from somewhere, or my rich uncle's going to lend me $50,000. I got to have a source of funds, to cover my expected future cash outflow requirements. And then in October, I'm starting to pay it back. That's why you see the negative numbers in the bank line of credit, because that's increased bank line of credit or decrease. I'm paying back $3,000 in October, $4,000 in November, $1,000 in December, $5,000 in January, and then I got to borrow another $6,000 in February, according to my forecast. So what I'm doing with this cash flow forecast is I am anticipating cash flows from operations, sales, and expenses. I'm anticipating cash flow from investment activities, like buying equipment. I'm anticipating and planning for cash flows from financing activities, which is borrowing and paying back money. And I'm anticipating cash flows of a profit distribution nature, all of which means that I'm understanding my expected future cash flows, and I'm planning for it well in advance. And if I need to increase my bank line of credit to support my expected business plan and cash flows in the future, I know it well enough in advance to do it. The old adage is that you want to borrow money from your bank when you don't need it, not when you do need it, because when you get desperate, it's too late. You need to plan it well in advance and line up a source of funds well in advance from when you actually are going to need it. And you can't figure that out without doing a cash flow forecast. And so in 2020, 2021, and in the future, where we're going to be entering a different world, we've already entered it, we're going to be exiting a different world and have a new post-COVID normal. I think cash flow planning for most businesses becomes more important than ever. And this simple little tool is the forecast view of cash flow. You update it on a monthly basis based on real world impacts and future changes that you would expect to see what you've got to do in terms of business financial management. It's a tool that big business uses all the time. And my view is that small businesses need to operate their businesses just like the big Fortune 500 businesses on the New York Stock Exchange do. It's just a matter of scale, you know. And if this type of tool, this type of planning is good for Joe, then it should be good for Sam, you know. And it's not rocket science. It's the kind of thing that a SCORE financial mentor can help you with until you become comfortable with it. And you will become comfortable in reviewing and using your income statements, your balance sheets, your cash flow reports, and cash flow forecasting once you do it time after time. It's no different than learning how to play tennis. If I ask you to go on a tennis court and give you a tennis racket and a ball, and you've never hit a tennis ball in your entire life, you don't have a clue what you're doing. You can't even get the ball across the net, much less play the game. You know, but if you whack the ball long enough and you got somebody serving you a lot of balls, and after a while you start to learn how to hit the ball and how to get it across the court and the net, and you learn how to move, and it's practice. It's, you know, practice makes perfect. Same thing with reviewing and understanding financial statements and doing cash flow forecasts. It's not rocket science. It's just different than most people are used to doing, and it's something that can be learned and can be mastered, especially with the help of financial advisors like a SCORE mentor that can help and assist you. So we'll provide both the blank example, the blank format, and this particular example to you, and it's something that you can begin to work on using and solicit the help and assistance of your accountant, your CPA, and your SCORE mentor. Is there anything else in our slide deck, Kathy? A wrap up, maybe? Yeah. I think I've already said most of that. You know, if you don't already have a SCORE mentor, there's the website, you know, lancasterscore.org. And you can go there and sign up for a mentor online application. We'll assign a mentor to you, and they'll get in touch with you and plan a meeting schedule. Figure out what your wants and your needs and your expectations are, and how we might be able to help you, and go about trying to do the same thing, or going about trying to help you. And of course, I'm emphasizing reviewing the financial statements on a monthly basis. I've beaten that one to death, so I don't think I need to do that any further. I guess the last point is worth a little comment. Last bullet point here. I cannot tell you how many times over the years that I've said to some CPA or some accountant of one of my SCORE clients, why aren't you helping them in terms of business financial management and business financial counseling rather than just preparing tax returns for them? You know what their answer is? They didn't ask me. Classic. Your CPA and your accountant have the ability to help you grow and become everything that you can be in terms of business financial management if you ask for their assistance. But most of them don't push it and don't volunteer it, because they, and they know the clock is running from a cost point of view. But they have the ability to help you and assist you. I once had a client, still been working with this client after 7 years now. And I met her in a workshop like this, happened to be face to face as opposed to online back in the quote good old days, unquote. And Nikki came up to me after the workshop and she looked at me straight in the eyes, and her nose was about a foot away from mine. She said, "I want you, as my score mentor." And she said, I understand operations management, I understand people management, I understand sales and marketing management, but I'm clueless, with regard to financial statements and financial management. I need to learn this stuff. And I said, I'll be happy to work with you. And I did. And we've been working, as I said, together for 6 or 7 years now, I think. And every now and then, Nikki will call and say, I need my score fixed, and we'll talk about something. But Nikki has become so good from ground zero in learning and understanding about business financial management. It's that she's now the guru for the franchise that she operates. Her franchisor, has national conferences once or twice a year, and when they get together, Nikki is the one that's teaching the workshops, to all the other franchise owners about business financial management. This is stuff you can learn. You don't have to be a anal retentive like me. Yeah, and excuse me, get rid of that. You don't have to be anal retentive like me, a numbers person like me, in order to understand this stuff. It's stuff that you can learn. I think that was it, wasn't it, Kathy, in terms of the formal slide deck?
We do have one more question, and this individual, and it's actually Tina, if you want to ask your question, or I can do it for you. But you've never worked with QuickBooks, but you're planning to buy it. Is it good enough to keep the company finances? It does make cash flow reports and other reports to manage my business finances, even if I'm not a finance expert.
Yeah, Tina, there are several levels of QuickBooks. QuickBooks Basics, QuickBooks Pro. There's QuickBooks for manufacturers. There's QuickBooks for the contracting business. There's QuickBooks for retailers. QuickBooks for wholesale distributors. It depends on the type of business that you're in. You also have to make a decision of whether you want to get QuickBooks Online, which is the software as a service, quote unquote, where you're paying a monthly fee, to Intuit. The benefit of QuickBooks Online is that if you've got an external accountant, you can share your books with that accountant instantly, with a username and a password. They can go into your accounts remotely, and see all the information and make accounting entries and all that kind of stuff. Or whether you want to buy QuickBooks desktop version, which is just what we used to do. You buy it, install it on your desktop, and you run it that way. So there are different decisions to make, and ideally, you want to do a little bit of homework and study which one might be best for you. And that depends, number one, on your type of business. Number two, on how big or complex or simple the business is. And number three, whether you're going to be doing your own financial accounting and financial reporting with QuickBooks, or whether you're going to use an external contracted out accounting service to work with you, and which version might be best for them. And so you can answer that question by doing some homework for yourself, and or throw it at a SCORE mentor and make them struggle with you to help you.
One other thought, Tina, is you might look into a bookkeeper if you're just starting out with keeping track of your books. It isn't as expensive as an accountant, but they work with the QuickBooks platform. And if you have QuickBooks Online, you can do it with your bookkeeper online and keep track of everything. And that can help you get it set up and operating correctly, so it's easy to decide what to do as you move forward. So another suggestion might be just getting a bookkeeper in the short term.
Yeah,
Thank you so much.
Go ahead. Yeah, for a lot of my,
I'm really.
go ahead.
My company is a consulting company, and due to COVID, we are almost broke because last year our revenue was 0. So we have been doing all the finances, and it's so hard for me to handle that. So we are trying to catch up with something that really works and make us easier to do the things. The payments, we work with consultant. We don't have any inventory. We just work with 1099s and for taxes and everything. We are looking for something that help us to manage all that things, because our accountant is like, I don't know how to say this in a right way, but we ask him something and you get it 2 weeks later or maybe more. So we're trying to do things simple. So we thought that maybe QuickBooks, but that is not my problem. I saw all the QuickBooks and it's so complicated to make a decision which one would work for the company.